All right, everybody, it's another week of What the F Happened. If you've been paying attention, well, some of you haven't. It's summertime, so you're probably out there doing your gardens, having some fun, traveling around. It still seems like it's partying like it's 1999 because the big bust is probably very short way away, however you're going to say that. Anyway, getting back to it, I've got a really great show today. We got some good news we're going to talk about, from layoffs to travel bans to DeSantis. We've got all sorts of stuff to hit, but we're also going to sprinkle in a little bit of magic dust, and that's going to be bringing Justin from Kearns Capital in to talk a little bit about the hedge fund world, what that means, what's going on in currencies, because I know a lot of you probably want to know a little bit about, well, digital currency, Bitcoin, Ethereum, and Forex. So we're going to hit that. So, folks, we'll be right back. This is What the F Happened. All right, folks, we are back. It's What the F Happened, and this is another week, but this week is going to be unique. Not only is the news pretty alarming in some senses and pretty makes no freaking sense in another sense. God, I'm not figuring my words out. I need some more coffee, so I'm actually going to introduce my guest today. I got Justin on from Kearns Capital. What's happening on your end, Justin?
Man, it's a beautiful day on the West Coast, up and early, 6:30 a.m. Let's get it.
Nice. And then Steven over there in Florida, the land of, I don't even know what you call Florida these days. What's happening down there?
Well, right now we're the land of championship sports teams because we got the Panthers going to close it out tonight, hopefully, for the NHL Stanley Cup, right to go to the Stanley Cup. And then we got the Heat that lost last night. They struggled a little bit with shooting at home to close out the series, but they're up 3-1 over the Celtics, going to the NBA Finals. We got travel advisories coming out from the NAACP and Rick Scott, and we got all kinds of stuff happening in Florida. But there's a lot more going on in the overall economy and the global economy, and that's what we're here to bring you this morning. And there's a lot happening, so we'll get into it.
There really is. So, I want to thank all of you joining us. We got Instagram. We got a few from TikTok. TikTok's a bit late today, but then we've got our steady eddies from YouTube, Facebook, and all the others. So welcome, everybody. It's another week. I'm excited to be back. I've been on the road. Justin's been traveling like a traveling fool, but I guess we're all putting in some miles here, getting out there. But I want to kick it off with, what I drew this morning. So I keep talking about the economy and the recession, and a lot of people are starting to say, oh, that Chris guy's been predicting a recession forever, and it's still not happening. Clearly, you don't know what defines a recession, because we are in a recession by technical measures. Forget about what DC says, because they just changed the rules to do whatever agenda they want to push. So I drew this today, so I'll show this. This is a newsletter. So every single week we put out every single month we put out a newsletter, and I doodle a little thing here so you guys can see this, just trying to get you all. But the one thing I put in here is it's a picture of a giant whale getting ready to eat these two people on an inner tube, which are both, it's a husband and wife, both looking at their laptops. And the husband says, well, at least we still have our jobs. Well, the onlooker, this little guy right here, is sitting there with the popcorn waiting for the show to start, while the financial advisor's over here saying, it's just a paper loss. And then you all know who this is, saying, recession? What recession? Anyway, I think the picture does enough to tell the story. The only reason people don't feel the impacts of the recession that we're moving deeper into is because they're employed. But just today in the news, and it's in the news every single day, it's just depending on what company you want to talk about, Meta has started laying off another round, focusing on business groups. So this isn't the first layoff by Meta. Meta hires a lot of people, and they're laying off a lot of people, just like Amazon's laying off a lot of people, just like all of the tech companies are laying off people. But it's not just tech. It's also the auto manufacturers. they're laying people off. It seems like the only people not laying people off right now are the airlines and the hospitality. So when you really look at this, and Steven's got it up on the screen, Meta has started its latest round of layoffs. The reason I bring this up is it depends on what you're looking at, but you'd have to understand a little bit about economics. You see, there's leading indicators and there's lagging indicators. Airlines, hospitality are always a lagging indicator, just like real estate. Real estate's one of the, I mean, if you don't know this, it's been this way forever. Real estate's always been a lagging indicator. 6 to 9 months is what it lags the stock market. So what that means is leading and lagging. A lagging indicator like hospitality and hotels and airlines and real estate means that when the stock market's going down, those industries, those sectors do not feel the impact for anywhere between 3 to as much as 12 months after the stock market drops. And there's a real good reason for that, but we're not going to get into the reason. But then if you want to really know where we're headed, it's very easy to see. It's called leading indicators. The number one leading indicator you want to watch is transportation. You want to look at the trucking industry. You want to look at the railroad industry. You want to look at logistics. And you want to look at box manufacturers. Now, why would I say box manufacturers? I did an Instagram post on this, but think about it. If things are slowing down, they need less boxes to ship all that stuff around. And if you look at the forecast for the leading box manufacturers in this country, oh boy, that tells the story. It's way down, folks. They are cutting their forecast in a big way. The only ones that don't seem to be cutting their forecast, I can't figure this one out, is Abercrombie and Fitch. Who on here is going to Abercrombie and Fitch and buying all your clothes? You guys out there buying bikinis? What are you doing at Abercrombie and Fitch? Because you say
Justin looks like an Abercrombie and Fitch guy. I don't know.
Yeah, they just surged 18% after reporting a surprise profit. In other words, we didn't think Abercrombie was going to make money, the analysts, and they surprised them and they made money. So that is an interesting topic. What do you guys have to say about leading and lagging indicators?
And I think that to really dial this into your brain, we got to think about the credit cycles and just zooming out a bit. And if you think back to the pandemic, when the market's crashing and they're printing all this money and all this expansion, it takes some time for that to work through. And then we had this giant bull happen. Well, it's the same thing right now. You're seeing liquidity being pulled out, rising of rates. It's going to take some time for that to work its way back down. But for whatever reason, we just, as a society, think everything's going to go up forever. And it's one big cycle, and we're in the early stages of it. So I think if you just think about, like you said, job losses are happening, contraction's happening everywhere you look. It's going to make its way through all these markets.
Awesome. Steven, what do you think about it?
Yeah, I mean, like you guys are both saying, it's stuff you got to pay attention to because, everybody wants to buy when it's hot and buy when it's exciting. And that's usually the last time you should be buying. You got to follow, I was looking at Warren Buffett quotes last night, and I literally think we could do an entire episode just reading through Warren Buffett quotes because the guy's a genius. How he's like says one sentence and it's like, when there's blood on the streets, buy. I think that was a Rothschild thing, but stuff like that. And you hear that all the time, but so many people don't listen to it. And what we've been talking about now for a while, Chris, is, hey, the markets are going to crash at some point. I mean, it's inevitable at this point. And everybody's like, well, it hasn't happened yet. Well, we've lost 20, 30%. Over the last year or so in most of the indexes. So it is happening, maybe a little slower than, we've been saying, but at the same time, what's the inverse of that? What's the reverse of that look like? So what's the upside? So when you look at that, it's like, all right, if we know here and we know it's going to crash, why are we even trying to get that little bit last out of it? Like we know it's going to come down, just get out, get into other stuff right now and prepare for it. And so that's what we're here to talk about. That's why we do a lot with short-term real estate loans. That's why with Justin's hedge fund, how they're just in and out very quickly, because that's how you make money in these volatile times right now.
Yeah, and I got a couple people, and this is interesting. It means some new visitors are checking out WTF. So they're asking, what is this, a radio show? No, what WTF is it's a report of the news from the prior week. What we do is we look at all the news and we report on it at the end of the week, but we don't report on it just reading it. We actually rant, we rave, and we will argue. about the news. And that's why you come to this, or that's why you don't come. Maybe, when I ask people if you want me to be direct or you want me to be gentle, most people say they want me to be direct, which means you want the truth. But you have to understand the truth can hurt. And a lot of people, no disrespect to TikTok, but a lot of the soft folks on TikTok, they want me to be gentle. So when I say something that pokes their bruise or upsets them, they get super upset and mad. And I always just tell them, hey, why did you come onto this show? Because you should have known this show is the show where we rant, rave, and argue. And if you can't handle that, get out of the kitchen. Because you know what? You'll be the type of person that when you're at a party and you got a bunch of spinach caught in your tooth, if somebody tells you got spinach caught, you get mad at them that they actually told you that. But the person that wants the direct response, they're like, thank you so much for letting me know. You just saved me a huge embarrassment. So those of you watching this show, you really need to draw that line right now, because this is a direct show. It is not for the gentle folks. So if you're gentle, bye-bye. Anyway, let's get on with the show. We've got some other news. Let's hit it.
One thing, Chris, I think to bring up a little bit is talk about AI and how AI is going to affect trading and affect the markets. Because I saw a couple interesting stories come out this week. I just wanted to bring up real fast. So this is one of them right here that was sent in by one of our viewers. Actually sent this to us. But it was talking about how a fake image of an explosion near the Pentagon went viral, even though it never happened. So this image of, I don't know if they're going to show it on here, but there was an image of a big explosion right by the Pentagon, and it actually sent the markets into an 18% decline when the image came out because everybody thought it was real. And it kind of brings up the question of, we're crossing the line right now of what is real and what's not. I mean, I don't know if you've played around with any of these AI image generating machines, and what do they call, like medieval times or something? I forget the names, but they, you can type in different phrases and it literally creates these images, and people are releasing that. So, we see an image come out and the markets drop 18% because of it. Like, that's a problem. So where do we go from here with it? And then the other story that I saw come out that I thought was super interesting as well was that people are using AI to start picking stocks. So this was a Chat GPT can pick stocks better than top fund managers, according to CNN. So this is called the GPT Portfolio Trader. So they gave it $50,000 to see what it could do. And it went in and it started analyzing all these different stocks and rating them, giving them scores on if they should buy or not. And they went in and did this whole case study on it. I just find it very fascinating. I kind of want to hear you guys' take on that.
Well, I mean, Lazy Cash thinks that AI is a very scary thing because he just likes being lazy, and people are going to start ripping off his skills, and that's not going to be good. But I don't know, like go back to I think it was the 80s. They had a chimpanzee that studied, some charts of stocks, and they put them all on the wall, and the chimpanzee threw darts at the stocks, and whatever they picked, they beat the top analyst out there. So the fact that Chat GPT is beating the analyst, I don't know how good that really is. The analyst can't pick anything. I mean, hell, if you're following Kramer, you're probably batting about a 99% loss ratio. So the 1% that actually listen to Kramer and actually do the opposite of him, you're crushing it right now. You're just like the chimpanzee. So I think that's all Chat GPT does, is it just looks at Kramer and then it says, okay, Kramer says do this, we're going to do the opposite. And of course they're beating the markets and the analysts. I don't know. That's my take on it.
And there's so many implications with this. I don't know if this happens to you guys on Facebook and all the social media, but there's digitally created people now.
This cat's not even real. Everybody thought I had a cat on my desk. It's not even real.
Who knows? It's impossible. That's the world we're living in. But I mean, in terms of AI affecting the markets, I mean, it's already in the private placement world, hedge funds over 10 billion, more than 50% of the trading volume is now done with algorithms and AI. So it's all going that direction.
Yeah, and I couldn't agree more. Stephen, what do you think about AI and Chat GPT? And I don't know, what are your thoughts? Have you watched Terminator 8 lately? Terminator 2?
Yeah.
Just asking for a friend.
No, I saw a meme the other day though that said like the kid from Terminator, he saved the entire human race by instinctively lying to a police officer. Yeah, you guys, but anyway,
That could spin off the complete wrong way right there.
here's a 60-second video. I'll play real fast just to show you how quickly this is becoming just unbelievable. Just fascinating stuff, though, huh?
That's crazy. And, I want to make a comment. If they can do all that with AI, why can't StreamYard figure out how to stream Instagram and TikTok along with the rest of them? I mean, they're so smart. They can take an elk and put it in the middle of the city and put a sign saying, come in. But we can't get Instagram and TikTok on StreamYard? Man, where are our priorities these days?
If it's not fake, it's not going to work, apparently.
I guess so. All right. So where should we go here? I know Mark was making a comment that I think is worthy. He said, my business is slowing down a little bit. People aren't coming in to get food as much anymore because their money is going a different direction. They don't have the extra cash to come get barbecue. So that's an interesting topic. Now, restaurants, from what I've seen, haven't really slowed down too much, but that's Mark saying his food business is slowing down. So usually when you start seeing restaurants slow down, that means it's really hitting Main Street. You got the Wall Street slowdowns and the Wall Street stuff, but that doesn't really always translate to Main Street. But when you start seeing restaurants feeling the pinch, when you start seeing local businesses feeling the pinch, that's when there's no turning back. Matter of fact, there is no turning back. We're not going to soft land this thing. I'll tell you, I took my family to New York City for my daughter's 3rd birthday, and we went out there and we celebrated her birthday. But we took a private plane out. My friend has a plane, and he needed fuel, so we took his plane. Jokes. But when we were going in, there was a crosswind of about 25 knots. Now, some of you may know what that means. Some of you may not know what that means. But in a relatively smaller plane, when you're landing with a 20-plus mile or knot wind, and the wind hits the plane sideways right almost when you land, yeah, that's a frightening thing. And AI ain't going to fix that. So I have no idea what I was going down that rabbit hole for. But, hey, it was a cool story anyway, wasn't it? Let's get back to the news. I got to get another coffee. All right. So, Stephen, let's talk a little bit about real estate. So I know some of the folks on here are in real estate. How many of you on Instagram, TikTok, YouTube, and Facebook are in real estate? Put an I in the chat. Let's just get a Mark here. Maybe Mark just makes terrible barbecue. That's so we got a joker here on TikTok, Nicholas Miller. You should look him up, and you should show him the same hate he's showing to everybody else. We just got some people that just cannot be nice. But you know why they can't be nice? It's because they're not happy. They're really miserable people sitting behind a screen, and the way that they translate their misery is just by sitting there and hating. But you know what? Haters will save the hugs for you. And my kitty cat here, yeah, well, he's got a hug for you as well. Look at that. He's just airing his balls out. That's for all you haters. I hope you got a laugh out of that. Anyway, let's talk about real estate. So we got a bunch of people that are real estate. Stephen, what's happening in the real estate forefront?
Yeah, it's interesting to kind of watch all this play out because, rates have risen, which we've talked about numerous times, how a raise in rates like we've seen will double the mortgage payment of monthly mortgage payment of a house, even at the same price. So it's kind of limiting. But at the same time, with mortgage rates going up, what we're seeing right now is sellers that would typically be selling to upgrade or get into a new home. These sellers are refusing to sell right now because they have these low rates locked in. And one of the dirty tricks that the banks implemented many decades ago is something called a due on sale clause. And what that means is when you sell a home, they basically force you to close that mortgage out and start a brand new mortgage. You can't transfer the mortgage or transfer the payments and things like that because of that due on sale clause. So it forces people when you sell or move homes to start a brand new mortgage. Well, when you have a mortgage locked in at less than 3% and going rates right now just creep back over 7% on a national average, I mean, that's over doubling your interest rate that you're paying, which is going to double your mortgage for the same price houses. So that coupled with the fact, so when people, maybe they made some money and equity on their homes in the last several years, so they have that. But now once you sell, you take that equity, now you got to put that into a more expensive home because you're not going to find something cheaper. The market's gone so up now, and couple that along with the higher rates that you're going to be paying, it's just not making financial sense for people to sell these homes. So it's created a bit of a gridlock. And I think it's one of the reasons it's kept the market strong, because there's just a lack of inventory. It's not a lack of buyers. It's not a lack of sellers. It's a lack of financial tools available to make that transaction happen successfully. So it's interesting to see where that's going to go, because it can't stay in gridlock forever. Those traffic jams always eventually lighten up and move forward. So that's what we're seeing right now in the market. We'll see where it goes.
Wow, what a great explanation. Justin, do you want to try to tackle that one? That was pretty good.
Yeah, I mean, I can tell you what's going on the multifamily side of things, just because that's where I'm most heavily invested with real estate, and we are seeing cash flows get compressed. I believe multifamily is trading at a 20% discount from the top right now. And to your point, if you can't use the equity and sell it and go buy again, is it even real? I think that's what's going to happen with single family too. Unless we get rates back down to 3%, there's only one way for that asset value to go. Eventually, this gridlock ends, and that the asset values are coming down. That's just what I see. At least in multifamily, you're more diversified. You can handle a little bit of occupancy coming down and still cash flow. But I mean, we're already seeing cash flows get compressed. I'm hearing about bridge loans coming due and people having to liquidate at a discount and get out of their investments. So real estate's going to be dicey coming up here. But I think to your point, it takes a while. Like, it's going to be the last shoe to drop.
That's interesting. That's some great pieces of advice right there. And, I think I'll just give one little thing, and then I just want to go to a couple comments. When you look at real estate, if you look at the last couple of years, there was so much demand that drove the price up very quickly, and people were able to get financing because it was easy, cheap money out there. I mean, that's what happens when the Fed injects $5.1 trillion of new money into the system. Getting money wasn't really a big deal. But because it drove the price up, you got a lot of people, and I'm going to use your word, Justin, dicey. They got a little dicey in their valuations because they were valuing properties not just on the rent roll, but also on the appreciation. And now you're not going to hold the appreciation. The appreciation is going to go the opposite way. So there's a lot of things that can happen. Number one, the debt service. Once they start witnessing a certain, amount of vacancies, the debt service won't be able to be paid. It won't be able to. You can't pay the debt when you have the valuations where they were and the rents start coming down. As rents, or as tenants move out or reposition from A class to maybe B class to try to save a buck or two upon lease expirations, what you're also going to start seeing is you're going to see these landlords having a harder time getting the higher rents, because we've seen rents go up double digits multiple years in a row. And I'm going to come back to Nicholas. He was saying this, this is not a soft zone, and he's absolutely correct. So Nicholas, as much as I was picking on him, he's right. Like, you can be as direct as you want, but he said landlords are leeches, and I do want to cover that one in a moment. But the whole thing is as rents are going to soften a little bit, which you're starting to see a little bit of that in the multifamily space, is they can't get the higher rents, so they're coming down just to fill vacancies. Again, at what point can you push those rents down before your debt service becomes a problem? Not only that, most commercial loans are a 5 or 7 year lock. So a lot of these folks had 3 or 4% mortgages that probably are going to start coming due in a year, maybe 2 years, maybe 3 years. And when that happens, if we're still in this type of an environment, or even worse, that's not going to be good, because then their mortgage rate's going to go higher, and that's going to make it even harder to service it. But that's only a small piece of the problem. When you really think about the problem in real estate, that comes down to the commercial space, the retail commercial space. As you know, most of you are probably working part-time at your house and part-time in the office. And I don't want to say part-time, but you're splitting time between home office and office. Well, a lot of companies, including here in my town, Buffalo, Blue Cross Blue Shield, are downsizing. Blue Cross Blue Shield has this gorgeous, ginormous building over on the waterfront in Buffalo, and their lease is coming due. So what are they doing? They're moving out of that giant building. They occupy 100% of it. I can't even fathom how big it is, 100,000 square feet or more. And they're moving to a smaller facility. Why? Well, because a lot of their employees, a lot of their staff are working from home. They don't need all that space. That's just Blue Cross Blue Shield. That's probably happening with companies like Adobe and Facebook and all the companies throughout the United States. So as their leases come due, we haven't felt the pinch of this because obviously these big companies still have the money to service the lease, and they don't want to go into the problems if they default on the lease. So they're just going to wait for the lease to expire. When it expires, you watch. That's when the problem starts, because a lot of these giant companies, these big office buildings, they're not going to have tenants. And then when they go to release those buildings, how are they going to release a giant office building when most people are working from home? This is a really big problem, but it's also a really big opportunity, because as this starts to unfold and happen, which will be over the next few years, you're going to start seeing the price of those types of buildings and those types of real estate, whether it's commercial, retail, or whatever it is, you're going to see the price of them come down significantly. Now, some people would be like, well, yeah, but why would anyone want to buy it even at a discount when people don't want office space? Well, people need storage. People need apartments, lower price apartments, so they can chop those buildings up and they can make them fit the need of whatever it is. Because in some cases, it's cheaper to buy an existing building and convert the need or the use than it is to actually go build a new one. This is all coming down the pipe, folks. So you got to decide, is this going to be a giant opportunity, or is there going to be a really big problem for you? Because maybe you're the person that was rushing in to buy all those properties. That's why sometimes I fear syndications. Not all, but some syndications. They're so busy trying to place money and buy these properties, because it's the nature of the business, that I sometimes think that they forget that they're paying too much and they don't look at the downside risks. Not all, but some of them make these mistakes. So I think there's going to be a huge opportunity to buy multifamily apartment buildings way cheaper than they are now. So everything will be on sale in the next couple of years. But let me hit that one question. Go ahead, Steven.
Sorry, real fast before we move on, just very important there, what you just said. There's a lot of opportunities coming. You know, we're talking a lot about these markets and what's going on with the economy. And the bottom line is now is the time to be prepared for that. Whether it happens in 3 months, 6 months, 2 years from now, those of us that are ready and prepared with our money, we control our wealth, we have it ready to deploy, we understand, we're educated, we're going to do very well in the coming years. And so we're doing a 3-day training class coming up next weekend. So it's June 2nd, 3rd, and 4th. Chris and I put this on once a quarter, typically for the last 3 to 4 years now. It's June 2nd, 3rd, and 4th, called Money School Essentials 3-day virtual training. It's a virtual course. You can log in from your bed, from your couch, from your home, from your phone, from wherever you are. We record the entire thing. So I just wanted to invite our What the F viewers, Chris, to attend the training. If you go over to Money School training.com/registration. And then we have a discount code for you guys. So if you use the code SUMMER START, I'm going to put this in the chat box. It'll give you $100 off as well. So yeah, go check that out. moneyschooltraining.com/registration. Use discount code SUMMER START. But Justin will be there teaching about his hedge fund and what he's got going on. We have a handful, multiple other experts and speakers coming on to talk about real estate investing, controlling wealth, private lending, and how to be prepared for what's coming. So I just wanted to mention that real fast as you were talking about that, and then we can get into some other stuff here. And I got a couple cool charts to pull up too.
Yeah, no. So that's, 3 days. We've been doing these 3-day trainings for quite some time, and they're very well attended. So Nicholas, yes, you can come for $200, $197, and you can learn. And he says, and you'll learn nothing you can't read in a half day. Okay, Nicholas, well, then start reading, buddy, because, here's the thing. We got this Nicholas guy, which he's being direct. I like it. And I'm going to play into it a little bit, because here's where we get to argue. So Nicholas, the entire time we've been doing this, has said everything we've said is useless. he said, landlords are leeches, and we're going to come back to that. And now he said he said 3-day class, only $200, which could be a positive or a negative. And then he goes and says, and you'll learn nothing you can't read in a half day. So he might be correct. Maybe you could.
I'll put my money where his mouth is and say,
no. I want to point out a really important fact.
I'll pay you the 200, buddy.
Yeah, I think this is a really important fact that all of us can learn something from. So Nicholas might be right. If someone was witty and they knew the topics that we were going to talk on, they could go read for not a half day, but an entire day if you're a speed reader, and maybe you could learn, a chunk of what we're about to teach. But you see, Nicholas a second ago was the same person that was saying landlords are leeches. But then Nicholas also was the person that just a second ago, when I was talking about the price of real estate coming down, he said, good, maybe we can have actual affordable apartments. You see, Nicholas has a mindset problem. That is it. Because he clearly can't afford an A-class apartment building. He isn't living in a house because he just said, well, good, maybe we can have more affordable apartments. But yet he's the same person that won't invest $197 in his knowledge and his mindset to get on the right side so he actually can afford the apartment that he wants to live in or the house he wants to live in. He's so focused on cheaper, do it myself. His problem is he doesn't value his time. Your time, folks, is the most valuable resource you have. Nicholas doesn't understand that. Nicholas thinks that trading hours for dollars is the ultimate because that's what he's been taught. And because of that, if Nicholas doesn't change his mindset, Nicholas is going to be stuck right at the same place he's at, bitching about landlords, bitching about $197 3-day class, and saying he can do it all by reading books. Nicholas, I still don't understand why you're on here, but I like it. One step further, why does Nicholas think that landlords are leeches? Probably because Nicholas is a tenant, and probably because Nicholas hates his landlord because he's got to pay rent to them to live in their building. Nicholas would be the type of person that probably would prefer everybody just gives him everything for free. And if he got everything for free, he would value nothing, and he probably wouldn't even say thank you. Nicholas is the same son of a bitch that I had to deal with during the pandemic, that when New York, because that's where I'm from, told all the tenants that they didn't have to pay rent, Nicholas would be the first bastard that stops paying rent. And he would just think that's okay because he's owed something. The world owes Nicholas something. And because of that, landlords had to bite the bullet because of sons of bitches like this. We had to eat that during that entire pandemic period of time. They got to live for free with no repercussions, and they got used to this free living and handouts, which is exactly what the biggest problem in this stupid country is. It's not a stupid country, but I'm just on a rant, so just go with it. And because of that, after the pandemic opened back up, and after people couldn't just live for free because landlords actually could evict their sorry bastard asses, then what we had to do is raise our rents to make up for a year, 2 years, and in some states, 3 years of tenants just not having to pay rent. Nicholas happens to be one of those people. So congratulations, Nicholas. Dude, we love you, man. Just put your hand out. Everybody's just supposed to be taking care of you while you do nothing but bitch. Go somewhere else. I'm done. Sorry about that. Yeah, listen, some people come to this show to hear the truth. Well, there, Nicholas just got the truth, and he's sitting there probably thinking to himself, wow, man, he got that right. Or he's just going to continue with his rhetoric, and we're just going to not listen to him anymore. But that was fun, was it not?
Mic drop.
All right. What else can we hit? We got some other news going on here.
Check. This is just an interesting chart. So it shows the cost to rent and the cost to buy since back in the 70s.
Holy crap.
You kind of see some of these different charts, but it's very interesting. I mean, look how big the spread is right now from the cost to buy to the cost of rent. Look when we started to see that spread approach back in 2008 housing bubble. Boom, then we saw the collapse. So it's just, I mean, I could just show chart after chart and index after index, and everything is pointing the same direction. So it's pretty wild to see those.
Steven, this is exactly why when I just moved to Vegas, I'm renting this beautiful house instead of building one. I mean, the imbalance of the cost to build or buy a home versus what you can rent it for, it's there it is right there on the chart. It's mind-blowing.
I couldn't agree more, man. And you listen, like that right there, that chart really, really tells the tale that there's a massive need for nicer, affordable apartments in this country, because until the price of real estate comes down, which that chart just proves it will, because it has to, it's just supply and demand. And everybody right now is saying, oh, there's so much demand, but not at the cost. So the cost has to eventually come down. But right now, it's almost like a tug of war. Nobody's winning it because nobody wants to budge. But pretty soon, when unemployment numbers start going up and people start losing their jobs, I promise you, pricing will adjust and we will go into a deflationary period. Hope to God we don't hit a stagflationary period, but it doesn't look like we're going to be in stagflation because we do have inflation coming down. And unless inflation spikes again, which it could, we hopefully will avoid the worst outcome, which would be stagflation. Thanks for sharing that, Stephen. That's a great chart.
Yeah, and then there's one other one just to kind of reinforce that Justin sent me this morning. Where did that go?
Shauna said something while you're looking for it.
Yeah.
You know, this is Elon. You know, we quote Elon quite a bit. I mean, you can love him, you can hate him, but he definitely comes up with some good stuff. He said, it's easier to make an extra $10,000 than it is to save $10,000. Once you learn that, your life will be better. Nicholas, you should look at that and you should apply that in your life.
Yeah, you can never get wealthy by cutting expenses.
And you can never get wealthy by saving either. Your money's got to be working for you. So those of you that think you're going to get wealthy just by saving money, it's not about saving. It's about your money working for you. And that's exactly what we teach at the 3-day training. That's what we teach at the wealth webinar. That's what we teach every single day. And Justin, in a second, I want to talk a little bit about a way where people can make their money work for them in a private hedge fund that is just wild and exciting to talk about. All right, what do you got there, Stephen?
Yeah, this is what Justin sent me. So Justin, you want to hit this?
Good. Everybody, yeah, I want to show people this. This is really good. And Instagram, keep it up. I want to show Instagram this as well because this is really good. You want to talk through it?
Yeah, I mean, look, we need to look at modeling, right? I mean, cycles are cycles. They always repeat. And the current cycle we're in is scary comparable to the dot-com cycle. So, you know, these bear markets have big rallies where you feel like you're coming out of it. And if you look at the comparison of the chart, we are right back at the top of this bear market channel. And odds are that we repeat history here. There's too many forces moving against equities. There's too much liquidity being pulled out of the markets. And, you know, when the government wants things to slow down, the government wins. So it's just, the proof's right there. You can see where we're headed.
Yep. I mean, folks, just take a look at that. I mean, if you study history, you can see exactly what happened. Look at the dot-com crash and look at the NASDAQ May of 2023. See any similarities? Now, you should be really focused just on this piece here before it falls apart, but we're about right there. And I didn't bring it. Sorry, I've got to flip this around because, you know, I got a phone doing Instagram here, but recently there was a economic white paper that came out from one of the economists that I follow. Cash, sit down. One of the economists I follow, and he was showing the convergence points. And literally he was showing that we are on our way, very close to being on our way back down. That chart you just showed, Justin and Stephen, that's exactly what it shows. Like, it could be any day, it could be any week, it could be any month. We can't time the market, but we're right there where the only place it can go is down. Because to go up, what would you need? You'd need strong economic reports. You'd need strong employment numbers. You would need earnings reports coming out. You would need everything that we don't have right now, because all we have right now is companies laying people off. You're seeing things soften in the economy. You're seeing earnings reports come out not so good, even though, you know, the news, if you just follow the news, you would think everything is rosy. Abercrombie and Fitch surges 18% after reporting a surprise profit. Key word in that report is surprise. Surprise! We actually made money, believe it or not. I don't know how we did it. You know how? Nope. You know how? I guess we're going to chalk that one up as luck. That's right. Surprise. Okay, so surprises don't keep going. Things are softening, and pretty soon we're all going to be seeing that, wow, they were right. And I'm not sitting here trying to be right. Matter of fact, I'm going to put this on the line. I hope, and this might be the first time you ever hear it, that we are completely wrong. I really do. I hope that everything does rebound. I hope that everything rallies back up. I hope that everybody stays employed. That's my hope. Unfortunately, that's going to be a surprise too if that happens. So, surprise, it probably won't happen that way. But we can all live in fantasy world like Nicholas and just think that everything's going to be rosy and good, and every landlord's just a leech and a scumbag, and they're just going to give him free rent. I mean, we could live in that world, but I don't think we should, because it's not real.
How can the economy expand if banks are tightening lending and the cost to borrow is going up? how can the economy expand?
Yeah, and how can the economy expand when the one person that controls monetary policy, not person, but entity or whatever you call it, the Fed, when they're sucking money out of the markets, when they're unwinding their balance sheet, when they're tightening, okay, you can't. So you just nailed it. When banks are slowing down, when banks are not wanting to lend, when they're tightening, that's because the Fed is tightening and slowing down and pulling the reins back, which slows everything down. The only one that's not slowing down is this administration and their spending, and that is leading to another debt ceiling talk, which is bullshit. The only reason you keep seeing this thing about the debt ceiling and all of this stuff, and you see it every single day, is because they want you to focus on that. It's kind of that old thing, like over here, come on, folks, over here. Don't focus on what's going on over here. We want you to focus on this debt ceiling. It's nonsense. It's just normal politics. We've been here a million times. They're not going to default. They're not going to not raise the debt ceiling. All they're doing is playing stalemate as to this party wants one thing and this party wants another thing. They're each just not getting their own. So they're like a crying little child that wants to watch YouTube or wants to watch cartoons, and the parents say, no, you can't. We have to go. Yeah, that's what it is. You got a bunch of children crying and bickering back and forth, and eventually, well, they'll raise the debt ceiling. That's what they'll do because they're not going to default. The U.S. has never defaulted, and they're not going to this time. So it's really just a diversion, if you ask me. But that is simply my opinion, and that is not fact. What else we got? There we go. Ed said they started building affordable housing apartments here in Stuart, Florida. They just finished on a development, and for a 2-2, they're asking $2,600 a month. Oh, a 3-2, $3,200 a month. Affordable? Dude, listen, that's not affordable. Like, I'm not going to boast or anything, but I live in a really freaking nice house. And my mortgage on my house is less, well, a little less than what they're asking for that 3-2. Taxes put me over that. But like, Steven, you know what my house looks like. Like, yeah, it's definitely a lot nicer than the 3-2. But that's insane. It's not affordable, man. That's not affordable housing. But that's the reality of the situation we're in right now. The cost of building, the cost of labor, the cost of everything in this country because of the inflationary issue we had is so high that actually probably to the developer, that is affordable based on the cost to build that. So I don't know what the answer is. Welcome to the new reality, I guess, Ed. It's a scary one. But unfortunately, that's not a sustainable one. You know, it might be scary. It might be reality of today, but it's not sustainable. So regardless, why don't we watch that building, and maybe me, Justin, and Steven will end up coming in, making a bid for 50% off, and we'll buy it with our private hedge fund. Speaking of private hedge funds, Justin, let's talk a little bit about your private hedge fund, because a lot of folks that watch this, they think hedge funds are out of reach. They think, oh, the hedge funds are just for the wealthy. We can't invest in hedge funds, you know, but they can. And I think it's worthy to talk about not just your hedge fund, but also talk about how you stumbled upon this, because you and your family had a business that you guys had an exit. So that means, you know, you probably had a little bit of capital and you were looking to deploy that capital. But you didn't just want to throw it into traditional investments, because you're a little smarter than some of the people out there, like the financial advisors, saying just put your money in mutual funds and ETFs and stocks when they're at the highest point because it feels good. You were like, nope, I want to look at what the wealthy do, because now I've acquired some wealth and I want to mimic the wealthy. So can we just kind of start there?
Yeah, I think fundamentally the reason why people think that they don't have access to this stuff is because of the way the government set up the SEC guidelines to essentially incentivize the public to invest in all the derivative products, put your money into government-sponsored vehicles, and then they put on these rules from the SEC that make 506Cs, different structure of private placement investments. We have a clamp on us as far as what we're allowed to say, how we're allowed to advertise. So these products and things, even though they're in the trillions under management, the general public's never going to have a legit shot at that unless they do some digging, do some research, read a bunch of books to kind of enlighten themselves to say, wow, nobody became a 100 millionaire or a billionaire by dollar cost averaging into the S&P 500. Never happened once, right? So first thing you have to do is just understand that there are other options. You just got to dig for them, because the people who are doing it, they're not allowed to advertise it. So the private placement space is alive and well. And the first thing you should look up is the SEC guidelines for accredited investor, because if you don't qualify as accredited, you can't play in this space. It's another way that the government puts a big barrier to entry in front of the average investor. So in my opinion, if you have to decide what kind of investor you want to be, do you want to be the dollar cost averager playing with, let someone else, Wall Street, take control of your income and your nest egg in retirement? And the problem with that is no matter how much you save, you have to draw it down in retirement. And we all know the markets crash every 10 years or so. So you're going to live through 50% negative compound, 40, whatever the number is, but you're going to live through negative compounding while you're trying to live off of the principal. It's not a recipe for success, and you will live in a perpetual state of fear through your entire retirement. So you look at other vehicles, like I wouldn't accept that. So I kept seeking, I kept learning. And then I found that the SEC says to be an accredited investor, you either have to have back-to-back years, 2 years of income of over 200,000 gross if you're single, 300,000 if you're married, or a net worth of $1 million excluding your primary residence. I didn't qualify when I found this out. So my entire mission was I want to be that type of investor. So I'm going to put all of my investing into myself to increase my income, to increase my proximity to people who are doing these things. That's how I met Chris Naugle. I spent a lot of money to go to a mastermind that has returned me 20x because I invested in proximity, right? So the best investments are the things where you can't see the ROI until afterwards. And you have to put a lot of faith in that process. You get yourself accredited. Now you've got the income. I mean, if you don't have $100,000 to invest, in my opinion, if you want to play in this space, it's not time to invest. I would have it in cash or in a whole life policy. And then when you get to the level where you can make your first private placement investment, then you deploy 100,000 or more. And that's how you're going to play in this space.
Man, that is well said. Very well said. So tried getting everybody the ability to see that. So TikTok, I'll be right back with you in a second here. I got to put all these things back. So, when I heard Justin talk about this private hedge fund, I'm not new to hedge funds. I'm familiar with hedge funds, did them when we were in Wall Street. We had, SMAs, separately managed accounts, that were hedge funds, but I never had the ability to directly go and work with the actual founders of a hedge fund, which I always thought was pretty fun and I always thought would be really, really wild to be able to do. So when I heard about Justin and what he was doing, it wasn't just that it was a private hedge fund. It was what they do with the Forex. Now, all of you know that, there's a lot of turbulence right now in currencies. You got the threat of digital dollars. You got certain countries testing. You got pretty much every country moving to digital dollar. You got pressures on the US dollar, the yuan, and all sorts of changes with what oils can be bought and traded in the future and valued in, which is right now the US dollar. So you got a lot of turbulence. So if you've got a hedge fund that's primary focus is to look at the convergence points or the inefficiencies in currencies, and then you create a computer-driven algorithm, and this is where that AI stuff actually comes in, that can literally spot these micro gains throughout the day and make tons of different trades, just a trade on these little gains where the average person, number one, they probably wouldn't be fast enough to do this. They might not catch all of them, and human emotion gets involved. A computer doesn't have emotions, and neither do algorithms. So I understood what they did, but the biggest thing I liked is how they handled the downside. It's always good to talk about the upside, and that's how you woo everybody, but it's important to talk about the downside. What's the risk? And what they did is they use stop losses. So any trade that goes the wrong direction, correct me if I'm wrong, Justin, 1.3%. That's as low as it's as much as you could lose on a trade is 1.3%. So that right there, that sparked my interest. And the fact that, if I put the money in, I had liquidity of the money after a year. I loved that. I didn't want to tie my money up for 3, 4, 5 years, knowing that there's going to be tons of opportunities, but I was willing to tie my money up, put it into an investment because I believed and knew, and understood what it was for a course of a year. And so far, money where your mouth is, it's been phenomenal. I put 100 grand in, 50 from my self-directed IRA, 50 from my specially designed whole life, my private banking. And right now, this is actually as of April, I was, how long ago did I do that? Was it 3 months or 4 months ago?
Let me look.
I want to say it was 3 months ago, but each account has gone from 50 to 57,961. That's a 15.92% return on my money for however long I've had my money in there, which I think is 3 months, but it could be 4. Justin's looking at it right now. So if you do the math, my 100 has turned into 115,000 and change, about 115.6, give or take a buck or two. That's not too shabby. And the best part about it is not so much that it's grown. I mean, hey, anybody can get lucky with investing and you can have a good run. But the cool part is when you really look at the returns of this particular investment opportunity, when I compare it to the S&P 500 right here, the thing about the S&P 500 that oftentimes scares me is the fact that the S&P 500, some days it's up, some days it's down, but the down creates a drag and it's called the drawdown effect. So even though people get super excited about 1 month, like in July of last year, the S&P was up 9.11%, but the next month it was down 4.24. The month after that, which would be September of 2022, it was down 9.34. You just gave back all of your returns and then some, but now you're working on a lower balance because you've lost money. So it's going to take you more returns, a higher return to get back to just where you were. Where with this particular investment, it made less than the S&P last July at 3.5 versus 9.11. But the next month, it made 3.88. Very consistent to what it did the month before. In September, when the S&P was down 9.34, this was up 6.63. The next month, the S&P beat it at 7.99 when this did 5.15. But as I go through it, the thing that I will tell you, the difference is mine just slowly goes up. Not very slow either, 15%. For how long has it been now?
February 1st.
February. So February, March, April, May. So not even 4 complete months yet, 15%. But the beauty is it's just been a line up. There's not been any of that roller coaster ride, not 1 month up, 1 month down. And that's what I like, stability, consistent and predictable returns. And that's what I've gotten with this. So the biggest thing I know, this is WTF. We're not here really just to talk about private hedge funds, but if you want to learn more about this, join us this afternoon at 1 p.m. where Justin's going to be on again, and we're going to be diving deep into this. We're going to be talking about all types of investments, but we're going to be talking about risk management on investments. And that is something you all need to look at because it's the third law of wealth. Protect your wealth. You got to get really good at protecting your principal right now. It's not the time to really go out there and shoot for, swing for the fences or shoot for the moon. This is the time where you want continuous, predictable returns, and you want to protect your principal at all costs. Because as things get worse, as things deteriorate, you're going to really, really be focused on your principal and protecting that. And I think that's what you can learn this afternoon at 1 p.m. And you can just go to chrisnaugle.com and register for the wealth webinar. This one's perfect for my buddy Nicholas because it's free. So Nicholas, you can join us for free. We will not look at any of your comments because we already know what they're going to be. And we know you don't have $100,000, but if you want to just humor yourself because it's free, show up. You won't learn anything because you don't want to learn anything new. But what the heck? I'm always the type of guy that just likes to give even when people don't want to receive, because eventually, if I can get through to your thick skull, at a certain point, you'll decide it's time to change your life. And getting around the campfire will do that. So we welcome all of you, even our haters, to come to the 1 o'clock wealth webinar. Register at chrisnaugle.com. What else we got, Stephen? I got about a minute left. Is there anything else you want to report?
Yeah, I got a quick update. Let me see. Bud Light's not doing too well these days. So
well, good. I won't. Bud Light is not allowed in my fridge anymore. Somebody came in here and put Bud Light in my fridge. I was pissed.
So that whole controversy is still raging pretty strong, which is it's pretty impressive, to tell you the truth. I mean, that's really moving the needle right there. I mean, just to completely abandon your entire customer base is a hell of a move by a corporation. And these companies are not learning. Target is under fire right now. Adidas is under fire right now. I don't understand the corporate strategy here with any of this stuff, but I think it's one of those pendulums is going to swing back and give them a black eye and hopefully knock all this crap out of here. But anyways, just a quick update on Bud Light. I thought it was funny.
That is funny. And hey, Justin, I don't know, and I don't think I'd be one, but you think that might be a good time to buy, Budweiser stock right now because of that? Hey, if you can kind of put aside like the reasoning and all that stuff and just look at it from this might be buy low, I don't know, Budweiser. I mean, eventually, people have memories like a gnat, so they'll forget about this. It'll all blow over because, like Steven just said, literally, it'll swing so far to the left that it'll actually end up swinging back to the right, and then you'll just see two dudes in torn off shirts with muscles and big old jacked up pickup trucks, swinging hammers, throwing axes, and doing manly shit. And then all of a sudden, everybody's like, "Hell yeah, dude! I want a Bud Light."
I actually have a theory on that. So Bud Light isn't known to be the best tasting beer, and
No, I think it's pretty crappy.
and it's one of those acquired tastes where when you drink it enough, it just becomes like water. Trust me, I know. But now that I'm drinking some other beers, Yingling, Coors Light have been some of my go-tos for light beers. When we're out on the boat or at the beach or by the pool, and now that I'm drinking those beers, I don't know if I can go back to drinking Bud Light just from the taste. So I wonder if other people are going to be like that, like open their minds to something new and they're not going to go back. So we'll continue to follow that just because I find it hysterical.
Yeah.
I don't know what it is with these companies that just want to focus on everything but the main thing. Like if I'm hiring you to do my roof, like be the best at fixing my roof. Don't tell me about the cause, about the asphalt. Like, most people, you're just going to hurt your business. They want the service they're signing up for. Why muddy it up? And it's never worked for any company, and they keep trying this in corporate America. You have to wonder, like, what's really driving that? Like, who in the C-suite does somebody have something on where they're pushing these agendas through there? Because I can't imagine that a company would cannibalize themselves on purpose.
I can't either. And we may never know the answer to that, but you can definitely see the results of that. So I think, the lesson to take out of what happened with Budweiser and Bud Light and that whole shenanigans is don't do that with your business, because it probably will have the same reverse effect and you won't like it. And it might even put you out of business. Although they can probably weather the storm, maybe, it's probably going to hurt their profits and their stock price, which it already is.
So two last little updates for the week. Netflix has been talking about this for years. They say they are now finally cracking down on password sharing in the United States. So those of you with joint Netflix accounts, I know there's like 4 different households on my Netflix account. So supposedly Netflix is coming after us, says, get your own damn account, pay your own $10 a month. So that's happening. And then supposedly my Florida man down here, Mr. Ron DeSantis, will be announcing his 2024 presidential run today on Twitter with Elon Musk. So we'll see how that announcement goes. So we might have a new man running against Trump for the Republican primary against the president of the United States today, Mr. Joe Biden. So we'll see where that goes.
It's going to be you literally like, I am going to take and fill my cupboard up with popcorn, because it's going to be one heck of a final quarter went before that election. I'll tell you what, I'm not going to be able to get enough popcorn. Remember how they ran out of toilet paper? They're going to run out of popcorn. So get down to the supermarket and load up on popcorn and Coca-Cola, because pretty soon you're not going to be able to have any of that. And then, get some toilet paper too, because I'm sure that'll run out. But anyway, with that being said, Nancy, I want to give you a shout out coming in from YouTube. She's had the best comments. We didn't get to them, but join us today at 1 p.m. Eastern, Instagram, TikTok, Facebook, YouTube. Thank you all for joining us, and we'll see you this afternoon, 1 p.m. Eastern, where we get to talk about private hedge funds and all sorts of really fun stuff. Till then, have a good day.